Welcome back to the Deep Dive. Today, we're digging into the StoneX Group's Q4 FY2025 earnings call. And this wasn't just, another quarter. Management called it the end of their most active year ever.
That context is everything. I mean, they stacked up 6 major transactions in a single fiscal year.
6. And it all culminated in that huge R.J. O'Brien deal, the RJO deal.
Exactly. So they're asking the company to be a sprinter and a marathon runner at the same time. Our mission today is to figure out how they managed to balance all that complexity, that immediate cost of growth, against the need to, hit their core targets.
Absolutely. So let's get right to it, the hard numbers. Did the growth machine stall under all that weight, or did they power through?
Oh, they powered through. They set new records. For the fourth quarter, net income was a very strong $85.7 million.
Okay, that's up 12% year over year. That's solid.
It is. But the first place you really see the impact of all that M&A activity is in the earnings per share.
Tell us about that EPS figure.
So diluted EPS came in at $1.57. And while that's positive, the growth rate was, it was only 1% compared to last year.
Only 1%. What's the story there?
It's mostly math. The main reason for that slow growth was the issuance of about 3.1 million new shares.
For the RJO acquisition financing.
Exactly. They expanded the pie for sure, but they also added a lot more slices.
And beyond the dilution, you have the direct integration costs. I mean, mergers are always expensive up front. What was the explicit drag this quarter?
Yeah, it shows up pretty clearly in the financials. Q4 included $9.3 million in pre-tax acquisition-related charges.
So if you strip that out.
If you strip out that 13 cents per share cost, the underlying performance looks even stronger. It just shows they're moving fast on the integration, which, often means spending more cash right away.
Okay, so let's zoom out. The full fiscal year. Does that confirm the trajectory?
It really does. They achieved record net income, up 17% year over year. But for me, the single most impressive metric, the one that proves this whole model, is working at scale.
What is it?
It has to be the return on equity, the ROE. They hit 15.6% for the full year.
Which beat their 15% target.
Right. But what makes that so compelling is the denominator. They hit that high ROE even though their total book value exploded by 72% over just the past 2 years.
Wow. That is the definition of compounding at scale. I mean, it's hard enough to maintain a high return on a stable asset base.
Yeah.
To do it while the base is swelling that fast, it suggests efficiency is actually improving.
Exactly. It's proof that these acquisitions are adding immediate high-quality earnings, not just diluting the overall return profile.
Okay, let's transition into what drove these results.
Yeah.
Operating revenues surged past $1.2 billion, a massive 31% increase. Where was that concentrated?
Primarily in the institutional segment and specifically in anything related to scale. Listed derivatives revenue, for example, just exploded, up 76% year over year.
We know why that is.
We do. RJO contributed a staggering $89.5 million of that growth. And that's just in the 2 months they were actually part of the results.
That's a powerful sign of how accretive that deal was from day one. And securities revenue also did well.
Yeah, very well. Securities revenue was up 26%, and it was powered by these dual tailwinds. Volumes were up 25%, and the rate per million, basically their commission, was up 23%.
So more client activity, and they were getting paid more for it.
You got it. And when you put all that together, the institutional segment just becomes this clear powerhouse.
How much did it grow?
Net operating revenues for institutional grew 67%, with segment income up an even more impressive 73%. That segment is clearly the main beneficiary of the RJO scale.
But the call wasn't all positive. If institutional's running hot, where was the cooling effect?
The cooling was sharp. Yeah. And it was very localized in the retail segment, specifically FX CFD revenues, that's foreign exchange contracts for difference. They were down dramatically, plunged 34% year over year.
34%. Ouch. What caused that? Clients pulling back?
It was really just a lack of market excitement. Management pointed to a 32% decline in the rate per million, and that was driven directly by low FX volatility.
So when currencies are quiet, retail traders just aren't as active.
Exactly. And the spreads the brokerages earn on those trades just shrink.
So you have this interesting tension. The retail segment is super sensitive to market volatility, while the institutional business is driven more by that structural scale and flow. That hit must have really weighed on the self-directed retail segment's bottom line.
It did. That volatility crunch was the main reason segment income for self-directed retail fell by 51%. It's, a key tension in the business model. You have this massive growing, resilient institutional arm that's kind of masking this acute risk in a smaller, high-margin retail arm.
Got it. Now, before we leave product dynamics, they also talked about the challenges they had in precious metals last quarter in Q3. There was that weird dislocation in the CME metals price. Can you just quickly clarify what happened there?
Sure. It was a technical issue. The CME contract started to impute a value for tariffs into its price, which basically meant the contract no longer worked as a clean hedge for their physical metals exposure. And since StoneX is so big in physical metals, it just wrecked their normal hedging strategy for a bit.
And how do they respond? What's the outlook now?
They moved fast. They confirmed the business adjusted its strategy in Q4, moved away from that specific contract, and now they expect things to normalize. They even think it could be a positive environment in Q1.
That shows some real operational flexibility.
It does. It shows they can pivot quickly when the market structure changes under their feet.
All right, let's tackle the biggest part of the story. M&A. 6 transactions, with RJO as the capstone. Management really stressed their disciplined approach. What exactly defines a StoneX acquisition target?
Well, they have this really rigorous checklist. First, the deal has to be accretive to their ecosystem, so new products or a bigger client footprint. Second, clear shareholder value, usually through cross-selling. Third is cultural alignment, which is soft, but, crucial. And finally, they have to earn back any goodwill they pay, typically inside 36 months. They're very proud of not overpaying.
That discipline is so important, especially with a deal of this size. The RJO deal made StoneX the largest non-bank U.S. FCM, that's a futures commission merchant. It brought their combined client equity up to $13.7 billion. That is just a massive jump in scale.
It is, and an FCM is just a firm that handles futures orders and holds the margin for those trades. Being the largest non-bank player in the U.S. gives them this enormous competitive advantage.
But the success of a deal this big really hinges on the integration. The market needs to know those synergies are real. So what's the roadmap for the cost savings?
The roadmap is surprisingly detailed. Management validated their initial estimate, which was an ambitious $50 million in annual run rate cost synergies.
Okay, $50 million. And how's the progress?
They've moved incredibly fast. They've already realized about $20 million in annualized savings within just 4 months of closing.
Wow, that's 40% of the target right out of the gate.
Yeah, mostly from things like redundant vendor contracts and some initial overlapping corporate roles. Easy wins.
But the biggest piece, the most complex step, is merging the 2 core US FCMs. That accounts for 40 to 50% of the synergy target, and it's slated for Q4 2026. Isn't it the biggest execution risk here?
It is absolutely the single largest integration risk, and management was very clear they're delaying that specific step until late 2026 for a reason.
And that reason is?
They want to ensure the client experience is totally seamless. They said they don't want to lose a single client or a dollar of revenue because of a messy technical transition. So the sequencing is all about mitigating that risk. But you're right, the execution has to be flawless when the time comes.
Okay, so we have the first wave of savings done. The final riskiest wave is scheduled for late 2026. What happens in between?
The middle wave, that's targeting about 25% of the goal, and it's scheduled for Q2 2026. This is where they'll merge the overlapping non-U.S. entities in places like the UK and Asia and combine their U.S. broker-dealers. It's a very logical, phased approach. Lock in savings incrementally and save the hardest part for last.
Let's talk capital synergies. This gets less attention, but the liquidity benefits can be huge and immediate.
The target here is north of $50 million, and the brilliant part of this deal was the immediate capital pop. They executed a $42 million dividend of excess cash straight out of the RJO entity almost instantly.
$42 million on day one.
Pretty much. And the rest will follow, with another $20 to $30 million expected after those Q2 2026 integrations.
Okay, let's tie this all back to the investor. This whole strategy, the M&A, the scale, it's designed to grow those client custodial assets. Segregated funds, clearing balances. This is what they call their stable and predictable underpinning.
Precisely. That interest and fee income from client balances, the client float, increased by $28.8 million net in Q4, and RJO contributed $32.5 million of that. The acquisition didn't just add new clients, it fundamentally changed their interest rate sensitivity profile.
And this is where it gets really interesting for the macro-aware investor. What is the new sensitivity number after the RJO deal?
Because RJO brought in another $6.3 billion in client assets, a 100 basis point change in short-term interest rates now affects StoneX's annual net income by a colossal $53.8 million.
$53.8 million. What is that per share?
That translates to $1.12 per share. It basically transforms the stock into a highly leveraged macro bet on the short end of the yield curve.
That exposure sounds fantastic if rates stay high or go up, but doesn't that make them incredibly vulnerable if the Fed starts cutting next year?
That is exactly the right question to ask, and management addressed it head on. They are actively protecting that revenue stream. First, they're using RJO's expertise to invest that client float more profitably, targeting a spread of 15 to 20 basis points above T-bill rates.
Okay, and what about hedging against potential rate cuts?
They're opportunistically entering into swaps to hedge 30 to 40% of the underlying float over a 2-year window. This is their insurance policy. It basically guarantees a floor on a huge chunk of that income, offering stability even if rates fall. It's a strategic move that says they see this float income as foundational, not just some temporary bonus.
Locking in a floor on future recurring revenue. That's a very strong sign of management confidence. Now, let's turn to our This Is Not Financial Advice segment. You're on the investment committee. You've heard all the data record performance, the integration roadmap, that massive rate sensitivity. Pitches your highest conviction, outrageous but plausible trade idea based on this call.
Okay, I am pitching long StoneX, and the trade is called a synergy leveraged rate play.
A synergy leveraged rate play. Give us the tight rationale. What is the market missing here?
The market is underpricing the guaranteed floor. We have validated $50 million in annual run rate cost synergies and north of $50 million in capital synergies. The execution risk is known and compartmentalized. That roadmap gives you a predictable, multi-year earnings baseline.
So the cost savings stabilize the downside.
Exactly. And the $1.12 per share rate sensitivity provides the torque. If, and this is the bet, if short-term rates stay higher for longer than the consensus expects, StoneX is a highly leveraged instrument designed to capture that upside. The trade is simple. You're buying a company with predictable, protected earnings growth, but you're also getting a built-in macro lever for free. The synergy is the protection. The rate sensitivity is the turbocharger.
A very compelling analysis. This deep dive has really highlighted a company executing an aggressive transformation. The M&A engine is working, the custodial assets are providing stability, and the RJO roadmap is locked in.
Right. And the challenge for you, the listener, to consider is this. Management asserts that their much larger balance sheet and public status will accelerate revenue synergies cross-selling to all those new RJO clients. So the question is, how quickly will those massive revenue synergy efforts successfully outweigh the continuing segment-specific drag from that retail FX CFD weakness?
That is the ultimate balance to watch in the coming quarters: growth and scale versus market-specific volatility. Thank you for joining us for this deep dive into the financial ecosystem. We encourage you to keep exploring, asking questions, and digging deeper.